We're now going to go into the next talk, which is Capitalizing Growth Spotlight on Active Development. And it's on financial institutions. And our moderator for this is none other than Mark Dunford, who will come to stage with his three panelists. Please, a round of applause as they make their way to stage.
Hello. Perfect. Thank you so much for the intro. So with me I've got Connie, John and Ewan, who should be known to most of you, and if not, please come up and say hi to them afterwards. Myself and Ewan had a quick chat this morning about the session, and I think the primary focus of this session is the DFI institutions and what their role is, and what their evolving role is in African hotel investment. Historically, if we go back a long way, they were very active and they were a key part to a lot of the development we saw. Recently, we've seen them commit to less and less deals. I know Godfrey's around, but I don't think he's in the room just now. I actually wanted him on this session. And that's largely due to where we've seen interest rates in the recent past, and interest rates being so low and the cost of money being low generally. But now with interest rates hiking and the cost of debt climbing like it has, what is the role of the DFI now, and where is it going to fit into different deals? So I'm going to start with Connie, ladies first. And I think the first question I'm going to ask you is, where do you see the role of DFIs in hotel real estate deals?
So I think particularly when we talk about greenfield developments, that's where your DFI is going to come in. These institutions can often take much more risk than a commercial bank. And I'm not sure if I should say this or not, but pricing depends. So I'm not sure who's cheaper or more expensive, commercial banks or DFIs.
But there is still very much a role for the DFI in these sorts of transactions, in your view?
Definitely. Commercial banks have a different mandate. We look at providing different financial services, not just lending products, and we typically rely on cash flows that's been proven before we get on board, where the DFIs could bridge that gap between greenfields and the business being performing or reaching its growth stage.
I get you. Awesome, thanks. John, obviously, and I know you've taken a bit of a sabbatical from speaking, so please don't let the nerves get to you. You'll be fine, I'm sure. If you can just give us we're a room from across Africa, so if you can give us a 60-second or 30-second intro into exactly who you are and how you fit into this conversation as a DFI, and then we can talk a little bit about how you would compare to a more commercial lender.
Okay, thank you, Mark. Firstly, the identity of the Development Bank of Namibia is given in the name of the bank. We are development. We are not like, for example, Connie First. So we are there for developmental purposes. Development banks and development finance institutions have been created with a specific purpose and have a long history. I think it goes back to the history of the reconstruction of Europe when the World Bank was started, and also the Bank for Reconstruction of Germany was started. So development banks have a mandate to develop. And if you look at some places where, in some jurisdictions, for example, in Singapore, it had a development bank, but it's now completely privately owned and listed on the stock exchange. But in the case of Africa, we have huge, enormous developmental needs. And so development banks still have a critical role to play in the reconstruction and the build-up of Africa, including here in Namibia. So our role is really, our mission is to support the government of Namibia to develop Namibia. And we are 100% owned currently by the government of Namibia, but we also do raise funding from the market and from other development finance institutions.
And how would you see, following on from what Connie was talking about, how do you see your role in a hotel investment, for example, a development investment in the hotel space? Do you see yourself working alongside the commercial banks or instead of a commercial bank?
I think not only for Namibia, but just in general, development banks are not there to compete. They are there to supplement. So for us, we don't see a competitive role. We want to supplement and we want to work with all players within development, whether it's a commercial bank, whether it's private equity, whether it's venture capital. We are not there to protect. Our key focus is to unlock new sectors. And our key focus is to impact and to have impact investment. So we don't want to compete with commercial banks. This is definitely not the space that we are playing into. Coming specifically to the hospitality sector, the Development Bank of Namibia, I'm very proud to say it, have played a key role during COVID in providing what we refer to in developmental jargon as lazy capital. And also, because of that, a number of exposures on our book companies, we managed to keep companies alive by restructuring, through providing lazy capital, through converting debt into equity, whether it could be a debenture, whether it could be a pref share. And that has really assisted the hospitality sector in Namibia. We have quite a huge exposure to hospitality. It's not only hotels, but it cuts across the entire value chain. It could be logistics is very important for us, transport, spas, restaurants, hotels. And the good thing is we are starting to see some recovery. We are still struggling from what I refer to as long COVID. And here is where DFIs can play a critical role, because DFIs can infuse lazy capital and long-term capital that commercial banks can't do.
Sorry, I just got hit with a coughing attack in the middle of that. So thank you, John. Ewan, everybody knows you here. Everybody knows Westmont. But how do you view a DFI's role now in the current market versus more commercial banks?
I think it's really helpful to hear Connie and John speak with regard to their different perspectives from a development bank perspective. I think, I suppose my personal view is that there is a concern that development banks could become less relevant in the hotel space. And, we understand as an industry the economic impact that we have, particularly on developing markets, whether that's with regard to employment creation, sphere of influence, all those elements, as well as the fact that we are a mechanism for growth. So as you invest in a new market, the hotels are an integral part, we would argue, of that infrastructural tapestry that opens up that market for a number of the different pursuits, whether that's in agriculture, whether that's in tech, whether that's in finance. So I think we would believe as an industry that we have a lot of attributes that really help, that if you like, the World Bank, the UN, governments internationally to achieve what they want to achieve with regard to economic growth, transferring of skills, all those elements. But when you then take that into the conversation with regard to accessing debt, quite often when you talk to development banks, it's a very similar financial offer to what you have from the commercial banks. So it means that I'm kind of going, well, are the DFIs relevant? Are they dinosaurs? Are they from an earlier era? Have they still got a relevance? I would like to think they have. I think what I'd like to see, and what John's talked about, is really powerful about patient capital. Maybe the DFIs could behave more like equity. If you take such an environment such as Namibia, so Namibia clearly is on the cusp of a major economic transition. Namibia could become an 8 billion barrel economy in hydrocarbon terms. Now that's transformational potentially. So you would have thought that if you had a hotel project in Namibia, you had a bank coming along and saying, well, let's give you a facility that anticipates that the economy is going to kick in 28, 29 or 2030, but actually if it happens a couple of years later, because we're a development bank, we understand that's not your fault as a borrower, we get the macro play. And that's where I think the development banks in our mindset would probably have not had that appetite in the past. And as I said, I think it's then caused their relevance to be questioned because they've not been as creative, they've not filled the gap where the commercial banks find it's more difficult.
And so longer term, more affordable alternative, slightly more understanding partner is kind of where we would want to see them fit in rather than the more commercial bank.
Yeah, I think to Connie's point, it's not just about cost, it's about structure. And I'd like to think that working with the development bank, you've got a genuine partner who sits down and goes, well, how do you structure the equity? Do you put some mezz in? What can we do with regard to principal? What structure works for this business plan? Rather than you tend to find with the DFIs, what's the guarantees? How do we mitigate our risk as the institution rather than actually getting comfortable on the business plan?
Yeah, that makes a lot of sense. Connie, so where would you see the big difference between a commercial bank and a development bank coming into a deal?
So from a commercial bank, stereotypically you have a relationship with your customer that's built up over a period of time, which makes it quicker to actually go through that credit assessment process. It's normally an established business as well. Yes, we look at available cash flow to repay, where your DFI, like John rightly said, is more a development, social aspect to it. What I also want to mention is, as First Rand Namibia, we're actually partnering with the Africa Development Bank, where they come in your SME space stereotypically, where it's the business now needs to grow to that next level and they need an injection of funds, and we then rely on the guarantee that fund gives us. So we do also cooperate, and we did that through COVID as well with the Bank of Namibia schemes and the DBN schemes as well, that John rightly said. So there's a space for all of us to play.
But a more kind of personal relationship with your end user then, I mean, John's a slightly different situation because he's a Namibian development bank, whereas if you're looking at an IFC, I still don't know if Godfrey's in here or not, but the larger DFIs that are Pan-African, they don't necessarily have the local relationship with their borrower where they can sort of take a view on other elements of the business and the broader relationship.
Yeah, and important as well, we can provide a range of services and products. There's working capital, there's loans, there's letter of credits, performance guarantees. So we do transactional forex. So we can really tailor make it to what our customer needs.
And you're traditionally a little bit quicker, a little bit easier to jump through your hoops than a development bank. Is that fair to say?
Yeah, no, definitely. We don't go into such a deep level of due diligence because we normally know the industry, we know our customer, and that enables a quicker turnaround time.
John, I was just going to turn it over to you and say, do you want to retort?
Well, I think there's a fundamental difference between a commercial bank and a development bank. And that difference lays into the liabilities that we issue. So commercial banks issue liabilities that are short-term, and they collect deposits. So another word for a commercial bank is also to say you are a deposit-takery institution. So when you issue liabilities to deposits, then there is an obligation from the central bank to protect the depositors. And that's why commercial banks are subject to a different rule of regulation than development banks. Because development banks, people don't come to DBN and bring deposits to us. So we are capitalized by the state. We have special ways, special programs of issuing liabilities. And when we issue liabilities, we typically issue liabilities that will be long-term liabilities. And therefore we can match our assets differently. So commercial banks, I understand the challenge that commercial banks have because they have deposits on demand. It makes it attractive for commercial banks because on-demand deposits, it doesn't attract a cost of capital compared to a long term. And so therefore, commercial banks can sometimes be competitive in a short-term space. In development banks, we prefer not to give short-term loans because we believe that development is a process. You cannot have development over 1 year. So we prefer to then be in the long term, an impact on development in the long term. So I think that's the difference between a pure commercial bank and a development finance institution. And I think development banks, finance institutions is exceedingly important in Africa today. Because if you look at the challenges, the developmental challenges that Africa has, if you look at all the outcomes, whether you look at life expectancy, whether you look at the Human Development Index of the United Nations, you see the huge development challenges in Africa: transport, logistics, water, energy, this. Do you think commercial banks will go there? It's very risky. So there are some other instruments that can come in. Even venture capital finds it too risky. But venture capital can come in, private equity can come in. But at some point, you need a development bank to create that bridge. If we want to take Africa forward to a higher level of development, then the role of development finance institutions cannot be questioned. It definitely has a role.
I mean, I think we agree there's definitely a role. And you've sort of answered one of my next questions, which is what alternatives there are. But your point about the makeup of a commercial bank versus a DFI is obviously clear. There's no retail banking in DFIs, for example. So there's a lot more kind of tentacles to a commercial bank, where there can be a lot more tentacles to a commercial bank. What type of deals? I mean, if I was to say to you, what is your ideal deal? What type of deals are you guys looking for? What's your your kind of dream deal?
Okay, if I can be specific about hospitality now, our ideal deal would be greenfield, but we also go into brownfield because we don't want to compete with commercial banks. If there's a good commercial proposition, then we prefer that a commercial bank fund it. But we want to go into virgin areas, and therefore, if you look at the exposure, for example, that the Development Bank of Namibia has, it has been in locations in Namibia that is referred to as virgin tourism. So we go where it's very high risk. We want to unlock virgin tourism in the Konini region, for example, in other regions but when it comes to financing, for example, a hotel here in Windhoek, we prefer that commercial bank does it. We want to unlock the value where it's more deserved.
So you teed me up perfectly for my question to Ewan, which is, we've discussed it before, the fact that there's a lot of focus from DFIs on development financing rather than more kind of commercial deals. What's your take on that? Is that a good thing?
First of all, I would say is, Westmont today we're active in 4 different continents. We are a substantial owner of hotels, but generally we're an operator first and foremost, and we acquire existing assets. So my counter argument to John and to other DFIs is that actually there are assets out there in leisure destinations, maybe not always in city centres, that actually through a transaction with a new vision, new equity, new branding proposition can be revitalised, can create that experience. And it's almost a case of you can have domestic pioneers and then you can have private equity coming behind to take it on to its next chapter, its next opportunity. So I think sometimes the DFIs don't fully articulate that opportunity and the value of that second ownership play. Secondly, we are in an environment and we keep on getting hit over the head by the UN, by the World Bank, globally as citizens, we're very conscious with regard to our emissions and what's happening with regard to our carbon use. Why wouldn't we resuscitate assets rather than building new? You know, going off and just going for greenfield sites rather than actually resuscitating and utilising that carbon that's already locked into those properties. We think there's a moral, and we think there should also be a commercial incentive to do that. So it's also quicker to market, and as a lender, you would have thought that your risk profile would be very different. You could probably do a lot more projects if you were funding acquisitions and resuscitations of businesses rather than going for greenfield, which we all know, and we've all got the battle scars, the time, the increased cost, the speculation that goes with it, and unfortunately that's not always successful. So I would have thought that actually if you want to take a market, you know, we talk about Africa being an emerging market. It's not. It's got very strong pockets of sophistication now. And what I'd like to see is in those markets having a more robust market where the likes of Knight Frank can see transactions, they can see hospitality assets bought and sold. And that's where I think the DFIs can work with us of, we can do training transfer, we can do those spheres of influence, we can lock in that carbon rather than building new structures. Surely that would be helpful to you, John.
Yeah, I think what we are saying is maybe the same. What essentially is the DBN, we don't look at a project in isolation, because you can't de-risk a project if you just look at a project in isolation. So what we are saying, we need to look at the ecosystem. And it will be very reckless for a DFI to fund a project in isolation without understanding the ecosystem and how we can link the ecosystem to the project financing that we are doing. And then there is not the role of the DBN alone, because when you develop ecosystems, you have to bring in partnerships. It's not a DFI that can unlock an ecosystem.
Yeah, and it is a, you know, to both your points, Africa is still very much a developing market, but at the same time there are these pockets of highly sophisticated or you know, well-developed assets. So you have that kind of two-tier situation to the market, and as a result, deals. So it's almost a case-by-case type situation. Connie, coming to you, anything to add to that? And you know, what would you say is your ideal type deal?
So the most interesting is your greenfields projects, then with the right mix of equity and debt and some mezz debt, if there's a development fund in there as well, and then to sort of nurture and grow your customer to where they're actually standalone, successful, and not so dependent on equity and DFI.
Okay, that's good. I have one more question for Ewan before we ask if there's any questions from the crowd. Ewan, with debt becoming so expensive, and I mean, obviously we're speaking in generalities across the continent here, but how do commercial projects remain viable? And I'm asking you because you are, you know, somebody who goes out and actually does acquire assets across the continent. How do you look at these projects, and how do they remain viable if debt is so much more expensive than it used to be?
I think what you need to do is really understand the business plan that you have and the asset you're going to purchase. Connie's point's correct. You know, we've built a relationship with banks where we're known for being good operators. We have a very sophisticated methodology with regard to asset managing, because these are complicated assets. Quite often when we purchase, Connie, we're not just buying so many rooms, we're looking at how can we expand that, what can we do to increase the revenue line, and then obviously get through to the NOI improvements. We sit down with our banks in-house, and you'll appreciate this, John, we do cash flow management. So we clearly say, where do we think this is going to go with regard to different scenarios in cash flow? You then want to make sure, Mark, that you proportion your debt. We're very cautious borrowers. We don't want to over-encumber our assets. We need to make sure that how we structure it is in a position is viable for each of the SPUs. However, we've also got a reputation where we have found the things we've been surprised. You know, the pandemic was a surprise. We were doing a large capital project in Morocco, for instance, during the pandemic. We had agreed a debt facility for that refurbishment. Unfortunately, due to delays, we had some overruns in cost. We didn't go back to our lender for more capital. we put that in as equity. So those kind of principles mean that when you do find a project that's maybe tight with regard to return, Mark, we tend to get a good hearing from our lenders because they know actually we're a trusted party to do deals with. But my point really is the fact that we would do more deals if the cost of debt was less. And I think that's where the DFIs need to step in and say, yeah, we can structure things in a different fashion so that we actually are catalysts for those investments.
And not necessarily from an interest perspective, but looking at the deal holistically and figuring out a way to do something that's
100%.
more cost effective. Do you think that borrowers lean on for their financiers too much sometimes?
We're lucky in the fact that in Europe we work a lot with the banks. So quite often the banks will come to us from a lending side, and they'll be asking us to be a bit of almost a third-party consultant on, can you do some stress tests? Could you look at this business plan? Could you look at whether this turnaround would work? Purely advising the banks. So that's then meant that in some markets in the continent, we're actually working with some banks who have got exposure in hospitality, and we're working then with those borrowers and the bank to try and navigate to what's a suitable landing platform. And yes, Connie, that does mean that sometimes I have to put fresh equity in, but what it does mean, Mark, is the fact that we're hoping that then creates some more liquidity in the market. We might not be the actual ultimate owner of that asset, so there might be an opportunity for somebody else to step in and purchase, but we think we've done something good to then position that asset as an investable vehicle.
Awesome. Great. Well, just as we wrap up quick, John, have you got anything you'd like to add before I ask for any questions?
No, I just want to concur that sometimes people come to development bank and they look at pricing, but we have a more complete offering, and our offering is in the deal structure. So we don't just look at pricing, we look at the deal structuring and the advisory services that goes along with the deal structuring. And we don't want to encumber the borrower. We don't want to see our clients going into debt.
Yeah, fair. Connie?
No, I definitely want to concur with both my fellow panelists. It's so important to be a responsible lender, and that is to recognize when not to add on more debt, because it will ultimately not pay off in the end, and then to try and look at different solutions to bridge that. So we carry that responsibility as well, whether DFI or a commercial bank.
Yeah, I think from my perspective, I often see developers or investors involving their financiers too late, especially financiers they don't know or haven't come on a journey with historically. So, have those conversations, have the meetings with the institutions you're looking to borrow from early on, and talk about the deal, or, from a macro perspective, not just from a micro perspective. We're just about to get thrown off stage. I think it would be the last thing I'll add from myself personally is that I've been asked a lot about what's been going on in Kenya the last 24 hours. And I think we're all here to help encourage people to invest in Africa and in African hospitality specifically. We've been through this sort of thing before. It's going to be short-lived, and ultimately Kenya's a great market, so don't be shying away from it just because of what's going on at the moment.
Hear, hear.